deducting business expenses against your self-employment income. So a business deduction reduces the amount of income on which you are going to pay tax. The more business deductions you have, the lighter your tax bill is. It's in everybody's interest to know, well, how much can I write off and what can I write off? And now, one thing to know is that when you become self-employed, some things that you're already paying for, like your car and your home and your computer, become tax deductions. Like these were expenditures that you probably were making even if you had a salaried income and that's all you had. But suddenly as a self-employed person, these become potential deductions. Particularly your car and your home are used partly for personal use and partly for business use. And so a certain proportion of those can be written off, but they become available to you as deductions when you have self-employment income. But they're certainly not the only things that you can write off. Businesses are as individual as people. You know, they're as unique as the people who run them. And the way that you decide to spend money on your business and you decide to maximize your income is very personal. So everybody's expenses are different, and there is not a giant guide somewhere covering every single item available in the retail establishments of planet Earth, indicating what can and cannot be deducted. There are, however, some specific rules about certain kinds of expenses, and there is an overriding principle that you can sort of apply to the expenses that you're considering writing off to decide whether or not you think you can or should be able to write them off. The reasonable expectation of profit. Now, this is a really short, really power-packed phrase. And if you understand this, you're ready to take on the CRA with, shield and dagger in hand, because this is what they are thinking. And so it is what you have to argue if they want to dispute you on this. Okay, so we're going to take this phrase word by word because each one of them is important, and we're going to go backwards. So let's talk profit. Profit, just to define terms here, profit is what's left of your revenue after you've paid for your business expenses. So your revenue must be bigger than the expense in order for you to profit from this expense. Okay, so when you decide that you're going to make a purchase for your business, you have to be doing it with the idea that it's going to enable more income than it's actually going to cost you. Profit is key. The next word is expectation. So whether or not the expense actually garners profit isn't the issue. The issue is, did you expect it to garner profit? And finally, was that expectation reasonable? If you're trying to defend a business expense and the Canada Revenue Agency wants to argue with you, or if you're trying to determine for yourself whether you should put it on your tax return, or frankly, if you're trying to decide whether or not you should deduct it, the test that you're going to apply is the reasonable expectation of profit. And if you get challenged, that is the argument that you need to win, that you reasonably expected to profit from it.